Welcome to the Making Money in Multifamily show, where we discuss everything to do with multifamily real estate investing. We believe it's the best way to gain financial freedom and build lasting wealth. This is where you'll find the best information and practices to help you succeed in your real estate business, whether you're already experienced or just starting out. Here's your host, Dave Morja.
Hello, listener. Welcome back. This is another episode of Making Money Multifamily, and this is one of the sub-series that we have on the show, Between the Sheets, with my friend Rob Beardsley. So welcome back, Rob. We're going to get into basically talking about cap rates and cash flows today, and kind of more of the math that people don't consider when they're kind of backing out numbers and doing some quick estimations of basically, is a deal a deal? So we'll kind of get into the nitty-gritty of the below-the-line stuff that people don't always consider. So with that, Rob, welcome back. And I guess we'll just kind of start with the top-of-the-line stuff and maybe go into what people aren't considering.
Yeah, so I guess we thought of this topic based on the idea that some people are looking at the market today and thinking, well, if I can buy at a, let's say, 5.5 cap and my value add gets me to a 6 and change, and debt's very cheap, it's at 4%. That seems like an equation that should result in
good delta. So let's do it.
Should be like 8, 9, 10% cash flows. And so when they're kind of looking at that in their head, they think, that's pretty realistic. I mean, in today's market, it shouldn't be too hard to deliver those type of cash flows. But I think today we want to talk a little more and peel back the onion and show just how difficult free cash flows really are, because those numbers alone don't tell the full story.
Yeah, absolutely. So I guess with that talk, we're pretty much saying that there's some assumptions that people might be making on, a quick analysis of a deal that when you peel back those layers that they aren't there. So what are the few big hitters that you are talking about when you're saying that people aren't
So the first one it's an obvious one we've talked about a lot, but simply replacement reserves, right? Most loan programs and most lenders require a form of replacement reserves that's anywhere from 200 to 500 even per unit per year. And personally, we actually include that in our above the line analysis of the NOI, but some people put that below the line. Either way, it's going to hit your cash flows. So
exactly.
So that's a big one. And just as an aside, the reason why we include it in above the line, it's just a way to actually, since you value the property based on NOI, by us including it in the NOI, it reduces our projected property valuation. So it makes us a little more conservative, since we know most buyers are looking at deals in that way. So that's number one. And we can just go in any order. But number two, a cap rate is usually NOI divided by purchase price. But there's a whole lot more that goes into buying a deal than just paying up for the purchase price. You've got all sorts of closing costs with, escrows and legal and things like that. So, and of course, operating reserves. And operating reserves today, it's wise to have a nice, healthy chunk of capital there. So, while it's great to have operating reserves, and you say, I'm holding back $200,000 in the bank day one to just for anything to go wrong. It's like, that's fine, and that's smart to do, but that does weigh on your cash flow, because if that's much more money that you have to raise, the cash flow as a percentage of your larger denominator is obviously smaller. So that's another thing. All the closing costs and capital that needs to be pre-raised up front to actually buy. So a lot more than just the purchase price goes into it. And another one is asset management fees. For the most part, asset management fees are just a reality of the business and are deducted from free cash flow. So typically what you'll see is you have your NOI, and then the lender needs to get paid every month, and the lender will sweep a property tax escrow, insurance escrow, replacement reserve escrow, and of course interest and also principal payments if you're amortizing. And then once that's paid, there's money left over for the sponsor to collect their asset management fee of 1 or 2%. And, that obviously, if you have a 6 cap, we'll get into the numbers obviously in the spreadsheet later. We'll see how actually that affects your, cap rate to cash flow equation, but there's just another hit to your cash flow. What else do we have?
So let's see, I guess let me pick your brain for a second here. just getting back to the asset management fee. So just really quick, why is that a below the line item, and why is that something that people aren't considering on these deals? When, I mean, it's pretty obvious that most of these deals these size, if you're talking 100+ unit deal, they're going to have some type of fee because there's overhead to be able to control this property. So what's the thought process, the school of thought as to why it's not even included in NOI, and that it's not? Then what is the logic that somebody might forego including this in their calculations?
Right. So, like you said, asset management fees are standard and really are required to run a deal. Those, without great scale, those are not a profit center for the most part. And the reason why they're not included in NOI is just because they are not uniformly assessed or calculated. Mm-hmm. So something like property taxes or other uncontrollable expenses are, number one, recurring and also pretty standard. So that's why they can easily be incorporated in the above the line calculation. But, depending on the deal, you might have no asset management fee because of the structure. It might be set up differently, or you might have a 1 or 2 or 3% asset management fee. So NOIs are always sought to be as a uniform calculation as possible, which helps if you and I are speaking deal terms and we're saying, that deal's a 5 cap, that deal's a 6 cap, we can pretty readily agree on what does that mean. And, asset management fees, we've agreed, doesn't mean.
It's basically one assumption where it could be an arbitrary number, this fee for asset management. So why bake that into the NOI when you can just eliminate it, and then everyone can do that quicker math in their head to, know
Right.
where the deal is kind of standing, versus having to assume and ask the question, is this a property where they're charging 2%? Is it a property where they're charging 1%? I mean, why even, have to make that guess right now today instead of just eliminating it from the NOI and moving forward?
It's the same reason why debt assumptions aren't included in cap rates, right? Because your debt might be different than my debt. So I might have more leverage, you might have less, and my cost of capital might be cheaper than yours or more expensive. So trying to remove those layers to get to that core NOI. That's why there are such a thing as below the line calculations for individual personal line items as well as non-recurring. Speaking of non-recurring, the deals we buy, no matter what kind of deal it is, real estate depreciates and requires maintenance. And so, we may accurately project our repairs and maintenance budget, but there's always CapEx to be done. And replacement reserves do a pretty good job to catch those, and we include those above the line, so that makes a lot of sense. But there is often CapEx required that is unexpected. Maybe it's one time. For example, we had an inspection done by the city, and they said, hey, you need to have a fence in the back of the property. We did not budget for that. That's not an annual operating expense, but it's $10,000 that we now have to spend, and that has to come out of free cash flows. Cash flow, instead of being distributed, it's held, it has to go back into the deal. So CapEx is also another below the line item that can affect the relationship between here's my cap rate, here's my cash flow, and there's some things that get lost in that translation. Another thing is amortization. So when you have that delta, like you said, of let's say a 6% cap rate, 4% debt, and that takes you to an 8 or 9% cash flow, that's very true, and that's a terrific thing to have. But then when you start amortizing and you're paying principal, cash flows get reduced severely. So I don't know if people really give amortization the full credit it deserves in terms of how much it can affect cash flows. A lot of people say, we've got 3 years of IO and our value add will be implemented, so by the time that the principal payments kick in, we'll cash flow just fine and all that. And it kind of hides in a model. It kind of hides the aggressive step up in the cash flows.
Well, yeah, I mean, you're moving from, just an IO payment, say, to now you're moving money from just the cost of interest to now you have to allocate money to, the principal pay down, which is, like you're saying, a totally different ball game. And it's definitely going to take a hit to that, versus if you just, sure, you're paying a little more interest on an IO, versus the interest on an amortized loan. But it's more money that you have to allocate away from
distributable cash. Yeah. And the big thing about amortization today is with interest rates so low, amortization is a bigger expense or a bigger portion of your payment, in relation to your interest.
Exactly.
Interest is so low, and I actually kind of did a table of calculations a while ago in an article where if your interest is 5%, then when you amortize your debt constant, which is your all-in payment, basically, including amortization, I think from 5, once you amortize, it might be 6.75. So it jumps it like that. But if your debt costs you 4%, you're going from 4 to 6. So as a percentage, it's a larger jump, right?
Interesting, yeah.
4 to 6 is a big leap compared to, let's say, 5 to 6.5, right? And similarly, if interest rates are 3.5, and then you amortize, that 3.5 will jump to, I don't know, 5.5 or something, which again is
shy of 6 still.
It's a bigger percentage. So a lot of people, and there's nothing wrong with interest only. I love interest only, and there's nothing wrong with cheap debt. Cheap debt is obviously something to be utilized, but it needs to be, you need to be aware of how cash flows can be reduced when you start paying down principal.
Yeah, basically, I mean, use IO as a tool when you can and if applicable, but when you're penciling the deals, don't make the future cash flows and the numbers when you're backing out for these distributions to only be based on the IO numbers. You should be able to, your business plan might be 5 years and you have 2 years of IO, and you should still feel comfortable with the cash flows on year 3 when you're bumping into principal payments and amortization payments. So definitely something to consider.
Unless you're buying a big value add deal with a lot of lift in your NOI.
Yeah.
If you're buying in place cash flow, you should actually look and see what your year 1 cash flow would be if it were amortized, right? Obviously, don't do that if you're buying a bridge deal where there's no cash flows going in.
Yeah, I think this more discussion is more for just valuating a deal where it stands today, right? So
we're just talking arbitrary and seeing that. But again, actually, from our previous episode talking about how deals are very light on cash flow today, just given market dynamics and all of that, being able to deliver even the pref of 7-8% is very challenging for quality real estate because cap rates are so low. So even if you can buy at a 5 cap and your debt's a 4, that doesn't mean you're
not levered up that high to hit 8 pref. So
you can't even get to an 8 pref. And if you're amortizing, like we said, that 4 takes you to almost a 6.
Yeah.
So if your cap rate's a 6 or a 5 and your debt's constant
now
a
you're
6,
in a negative delta.
You have negative delta. So your amortized cash flows will be 3 or 4%.
Yeah.
So the reality of being able to hit prefs is very challenging without the benefit of IO.
Yeah, that's really interesting. I'm kind of running out of blanks. Is there anything else you wanted to cover before we kind of got into the spreadsheet to show how these numbers play out?
Yeah, let's just dive in.
All right, let's do it. So once again, just if you're kind of listening to audio, it might be better to take a pause and jump up on YouTube or try to follow along and maybe catch up on it later. But yeah, we're going to jump into the spreadsheet right now. All right, so we are now back to the spreadsheet. We're looking at Rob's model. We're on the investment summary page, kind of like we always start out at. And what do we got going on in this deal, Rob, that we're going to present as a kind of exercise?
Yep. So again, we've got $10 million deal, and again, it's a steal of a deal at $50,000 a door. So the difference is, to just make the example, this is not a value add deal. Our hypothetical deal here, we are buying a 6 cap, and this deal is a 6 cap forever. So what we'll do is we'll show you here. So you can see the in-place numbers. Our hypothetical T12 results in $600,000 of NOI, which then divided by a $10 million purchase price, that is perfectly a 6 cap. And like I said, our hypothetical deal has no upside. It's a 6 cap, and forever it will be a 6 cap. So you can see our stabilized assumption is a 6 cap. And we have no rent growth, no expense growth, no property taxes, nothing. So we're at a 6 cap forever. So that's just to show you the example. And then back to the summary page. To start out, we're going to do an unlevered deal. So let's just say, as an example, you're buying this deal with no leverage, all cash. So you can see that to buy the deal, it's not just going to cost $10 million, it's going to be $10,580,000. And why is that? You have, in this hypothetical, 3% in closing costs, so $300,000. And what is that $300,000? That is property tax escrow, insurance escrow. Those are usually big numbers, especially in areas with high insurance, high taxes. Now, again, those are escrows, which you get back at sale, but again, that is held through the life of the deal, so that increases the equity that you need to come up with. And then other things like legal, maybe some inspections. You've got environmental report, PCA report, different things like that. An acquisition fee usually paid to the sponsor. And then we've got some reserves. In our hypothetical deal, again, this is no value add. So there's no CapEx budget. We just have 180,000 in reserves, which equals to 2 months of operating expenses. So again, like we talked about how you hold reserves, it's great. But here you can see a 6 cap deal for the life of the deal only returns 5.4% cash on cash.
Yep, there's a red flag right there. Wait, what happened to that 6%? And that's that 580 like we were just talking about. So
Exactly. So that was the key there. So just showing you that the closing costs and different, the operating capital required to run the deal will take your 6 cap down to a 5.4. And again, this is if you are lucky enough to be buying a 6 cap in place in today's market with no upside. I mean, even deals with no upside that are quality real estate are not trading at 6 caps, right? You try to buy a core stabilized deal, it is still going to be trading in the low 5s.
yep.
So, but let's just say we found a great deal at a 6. Now what we'll do is to start, let's layer in 75% leverage at that 4% we talked about, and let's assume a 1 year of IO, and then behind that is 30 years of amortization. So now let's jump back and we can look at the summary tab and we can see what happened. So now that we have leverage, our 6 cap levered with 4% interest only debt payments, now we're at an 8. So it actually got us up to, kind of like we talked about 7, 8, 9%. So it got us up to nearly 8. But then look what happens when we amortize. That's a big hit to the cash flow. So just really shows you that a 6 cap, when you have 75% leverage at 4%, but amortizing, you're actually getting negative leverage on your 6 cap.
Yeah, the delta there is basically too small to be able to. I mean, in this case, it's a 6 and 6, so it's 0 delta, but it's not big enough with the amortizing payment versus the interest-only payment to be able to, help improve that lever. That lever is actually a hindrance. So you saw that IO that jumps up. That's great because now you're only making interest-only payments, and it's not, a big cost to the cash flows. But then when you have to tack on that principal and you're amortizing down, you see, how it drops that far below. So let's I guess maybe we'll try. Can we play around with this and get it so that we actually use this as a positive lever in year 2?
Yeah. So let's just say that it's a value add deal, and part of your value add is to reduce utilities, let's say. And let's say it's going to take us 12 months. So in year 2, you'll have that value would be built in by year 2. So let's see what happens. So let's take it to, let's try 150,000. So that oh wow, our math is good today. 6.5% exactly on the
Nice.
the cap rate. So let's see if a value add plan that pushes your cap rate from 6 to 6.5 is enough to get some positive leverage on your cash flows. So let's see. So again, as you're building up on your value add, now we're instead of 7.9, we're at 9.1. So that helps obviously. And then our 6.5 stabilized in year 2 is actually now a levered 5.9 in free cash flow.
Yeah, we were originally 5.4 before all the value add and the debt. I think we were at 5.4.
5.4 unlevered, and now with the value add and the leverage 5.9. So you can see still with a 6.5% cap rate operating, we're not getting to our desired 7 or 8 pref when you amortize. So we're just kind of showing investors and sponsors the difficulty of cash flow and hitting prefs, and a lot of people are posting really nice returns in today's market because not of cash flow, but because of appreciation and the sale. And, someone looking a little more closely at cash flow should understand how all these numbers play in together and really appreciate the difficulty of generating free cash flow.
Yeah, and something to point out that's interesting, Rob, just to kind of make aware for the listener, looking at that delta in, say, year 2, it went from 5.4 to 5.9% cash flow. And then that delta is 5, right? 50 basis points. And then what happened to our cap rates? That was also 50 basis points. So it's, just important to note there that is that delta, that change right there. You can see it. So that offset from 6 to 5.4 in the original, that 6.6% you're never going to get back. But when you're able to, make that value add and inflate your cap rate based on increasing the NOI of the property, that you can directly see that increase in the subsequent years' cash flows. So just thought that was interesting to see visually.
Yeah.
And then I guess, is there anything else we want to play at as far as a scenario goes? Maybe how about we just do really quickly, if we don't have a 6 and a 6 and we say we have something kind of more advantageous for a cap rate, or I guess not even a cap rate, but I guess just NOI versus the cap rate. To
more value add.
Yeah, basically, yeah.
Well, let's take it to, now we're going from a 6 to a 7 cap, which if you're not used to calculating yield on costs and evaluating value add deals, the name of the game on value add is not what you're buying at, obviously, but it's what you can stabilize to. So while it's not true, some people say, well, hey, I'm in the value add space, therefore cap rates don't matter to me. That's not true either. The right answer is you need to be hyper-focused on yield on cost. So what return are you getting on an unlevered basis from your purchase price plus your improvements to the property, and how much are you improving the NOI divided by how much that improvement's costing you? And so that here is our yield on cost here, and you can see getting a 1% increase in your operating cap rate is a good value add plan. And now that we have that here, we can look back at the summary and we can see that we're getting pretty close. I mean, now our cash flows on an amortized basis are 7.3, which is impressive. And as you can see, the IO is over 10%, which is rare and difficult.
Phenomenal, yep.
Yeah. So that is the power of the value add. And for deals where people are buying with permanent debt that has an IO component and then begins to amortize, I mean, that value add is crucial to get right, so that in subsequent years, you're not disappointing your investors and saying, hey, all that cash flow that we're projecting, it's actually it's going to pay down the debt's principal.
Yeah, that's an excellent point too. And then I guess, could we just switch back to the other page there for 1 second? There was something I wanted to point out that, and then just to reiterate, that 7 to 6, I mean, you're looking at what? That's a almost 17% increase on the NOI, just doing some napkin math, 1/6 of that increase. So, I mean, you can see, going back to the original page, sorry to make you flip back and forth, but you can kind of see how that, really plays out into comparing those cash flows compared to what we originally had with the no value add play. So it helps you visualize a couple of ways, how that increase can occur. And just to kind of paint that picture too. Is there anything else you want to touch on, Rob, before we call it quits on this one?
No, I think it's pretty straightforward on this one.
Awesome. Yeah. So tune in for the next one. I hope you enjoyed this one. Thank you for listening. This has been the Making Money in Multifamily podcast. If you have any questions, comments, or would just like to connect, please feel free to check out the show notes for how you can connect, or visit longviewacquisitions.com.